Good afternoon, everybody. Uneducated economist here. So, I can't not get the bond yield rising, Treasury general account, the whole drawdown thing. I can't get this out of my head. It's the only thing I seem to be thinking about for the last couple of days, so I have to do another video on it. Now, some of the things that I found interesting in it is that as I go and try and do research and find some articles or find people talking about it, they don't seem to be keying in on the things that I want to talk about, or at least the things that I want to know for questions out there, because a lot of people are looking at it and they see what's happening, they understand the mechanisms, and they can kind of predict the cause and effects from this stuff. But what I feel is more important is how the money got there. That to me is the most important part. Now, in order to understand this Treasury general account and how the money got there, you really have to go back a year ago when the stimulus packages passed. Because that's really where it took place. The Treasury, like Congress, said, okay, we got the stimulus package going. And part of this stimulus package was taking from the, what do they call it? The Exchange Stabilization Fund. And they took some money from this particular fund, and they created some lending facilities with it. Now, they took the money, gave it to the Fed. The Fed leveraged it up, to hundreds of billions of dollars, and then funded these special purpose vehicles with it. This was only capable, like this isn't something that they could say, hey, this is a good idea, let's do this. The only way that they were able to do that whole thing was through the stimulus package, was because of the unusual and exigent circumstance. Now, that exigent circumstance, that means exit, like you have the exigent circumstance. So a good way to understand it is like, if you can imagine a police officer standing outside the house, there might be a suspicion of something going on inside the house, but he doesn't understand, or know quite what's going on inside of there. Something like a scream, a yell for help, a gunshot, anything like that gives that police officer some kind of reasonable belief that there is something going on in there that needs that immediate attention, that exigent circumstance. That's what they need in order to enter into the house. Otherwise, they need a warrant, even if he feels that there's drugs or something going on inside the house. Unless there is something that says that he has to immediately go into this house in order to do something about what's going on inside of there, then they don't have necessarily the authority to continue any further than that. But for like someone yelling for help, that would be an exigent circumstance. And that's the exigent circumstances back when the stimulus packages passed was used in order to create these lending facilities. Now, time went on, lending facilities, like I've talked about this quite a bit, but some of the lending facilities really didn't get used. And Mnuchin says, okay, I want that money. And the Federal Reserve was just like, no, this is kind of like, we need this money here. And everybody kind of said, well, this is like Mnuchin and the Trump administration trying to harm the future administration, trying to tie, what do they use the words? Tie Janet Yellen's hands, right, from getting at this money. And Mnuchin's just like, yeah, whatever, give me the money, right? So the money goes back to the general account. And this is basically a place where, like, the Treasury can, like, write checks from. And that's where the money ended up going to. And I'll leave a link down in the description for that article that talked about how, Mnuchin was asking for this back and they were trying to argue. It was a great article because it hadn't happened yet. So you could see like a lot of the legalities and where this money was even, where it was even supposed to go and stuff like that. It was mentioned inside of the article. So I'll leave a link down in there for that one. But the money does end up going back to the Treasury general account, where Janet Yellen is now saying we are going to draw down on this stuff, and they have. The Treasury has been drawing down on this, and I will leave a link down in the description for that one too, where you can check and you can see where each day is going by, that account is dropping just a little bit. So they're obviously using that account. Now, something else that I found interesting is that just the other day there was a Treasury auction. Now, this is where I found it to be really very interesting, because that Treasury auction tried to auction off in a part of the yield curve, like amongst the duration, that was really in low demand. Okay, and I will leave a link down in the description for that as well. Now, I'm not saying whether or not, I'm not like, big into bond auctions. I really don't understand, like the whole, like where they come up with why they have the particular durations that they're auctioning off. Like, I know it has something to do with like, maturities of certain things that are coming into play, but to be honest with you, there's probably a lot better strategy and understanding of that than I understand. The only thing I understand is that auction didn't go well, and there was a lot of talk about that. And in the link of that, in that link that I'm going to leave down in the description for you guys, they talk about that being like, kind of questionable on it. Like, why would they try to auction off this particular duration of bonds, knowing that it was like already kind of flooded and not much demand there? Already during a time when there's really not that much demand amongst these primary dealers. So I found that to be pretty interesting, okay? Because now you think about this all, and when you start putting this stuff together, you have an unusual and exigent circumstances that created money that should never have been there that eventually found its way into the Treasury. The Treasury is now using that money to write checks from, which is ending up over in the banking system. At the same time, they're issuing out less treasuries, but the ones that they did issue out, they issued out into a portion of the maturity that really didn't have a whole lot of demand to it. When that happened, the interest rates in that particular duration really starts to go up as they try to seek out the investor to buy these bonds. You kind of see what happens there? Like, if there is not a whole lot of demand there, then the interest rates rise until it finds the demand. And that's what was happening there. So during a time when this bond issuance is having yield issues, right? I mean, as far as, interest rates rising, they issue a bunch of them out into a particular area that had little demand, which would naturally cause the interest rates to go up even further. Was it done on purpose? You see, now I know a lot of this stuff is done on purpose because they had the unusual and exigent circumstance. They had to do something. There was no time to think about debts and deficits and anything else. We had to deal with this whole thing. And that's what they did. But this is what's come from it. Now, whether it was an accident or just the way it went down, $1 trillion ending up, I mean, it wasn't that much, but that's how much like is at the Treasury general account right now that they want to wind down. I think the money that they took back from the Fed, at least from what I was seeing, was up into like, the hundreds of billions of dollars. I don't think it was like $1 trillion. But still, that's how much they want to draw down from that Treasury general account. So all those things seem pretty interesting to me, that's how it ended up unfolding. Because it really seems to me that it was almost intentful, that this Treasury, a general account, really needed some funding in it. But you can't just go and like say, hey, Congress, let's just put a bunch of money up at the general Treasury account and start spending it. They were able to borrow money at incredibly low interest rates, get that cash, stick it into an account, now watch interest rates rise, and be able to spend from the Treasury general account without having to worry about, increasing the deficits on higher debt payments because, you're issuing out yields at a higher rate. You guys kind of see what I'm getting with this? It was like as if they knew that they needed to raise interest rates into the future. They know it, right? But the government cannot handle higher interest rates. They just, like, everybody talks about it. There's no way interest rates are going to rise because the government wouldn't be able to make the payments. This is a way that they're able to do it. Now, one of the things that I found interesting, and I'll leave a link down in the description for this one too, is that if you go and you look at like the Treasury issuance of debt, like last March, it was ungodly high. I can't even tell you. I can't remember what the number was, but it was just like, it was astronomical because they were, going into the stimulus packages and stuff. But one of the things that I found interesting is that if you look at April, like from all the previous, years back, is that you'll see that there is a very low amount of debt issuance from the Treasury during that time of those like Aprils. And so I'm assuming it must be from like tax payments. And so they, once the tax payments go into the general Treasury account or whatever, then you wouldn't have to issue out as much debt during that particular time in order to because you would have all the funding you would need sitting up there at the account. So I'm assuming like April is the reason why you see such low issuance out there. But I have a feeling that the low issuance is not only going to be from April, but it's going to be April all the way into like June or July, because the Treasury won't need to issue out as much debt considering that they're drawing down on this Treasury general account. And if they're not issuing out as much debt and they're putting in more liquidity into the system because of the checks that they're writing, at the same time the Federal Reserve is trying to do their quantitative easing, that's going to be a lot of cash entering into the system. And already there's talks about how there is too much liquidity and that it's having a hard time finding a place to go. Now, a lot of banks and a lot of institutions and a lot of places like to take that cash and they put it into treasuries. They put it into short-term T-bills because it's a quick turnover into cash again. But the problem is that the Treasury is not going to be issuing out that much debt during this drawdown from the Treasury general account. You see where I'm kind of getting at? And this is something that George Gammon was hitting on as well. So this creates a lot of liquidity in the system with no place to go. And once you start filling up money market accounts, and once you start filling up every place that all the easy access to liquidity is, and there's no place to go, the interest rates really start to go down. And it'll force them to go negative. Or start shutting money market funds down because they just simply don't want to have the cash on hand if they're not making any money with it. It would actually cost them to keep it in operation. So you can see where this can create a major problem. Now, the Federal Reserve, they could mop up all that liquidity very easily. They could start by ending the quantitative easing program. That would provide more bonds to the system, and it would stop adding liquidity in as well. The bonds, being that they wouldn't have to be purchasing $80 billion worth a month, and the liquidity, less liquidity going into the system as well. So, as far as like mopping up the liquidity, that's what it would be. Problem with that is that if the market heard that the Federal Reserve was going to end quantitative easing or reverse quantitative easing or even stall it for just a minute, that perception would blow them away, and immediately everybody would start cashing out. They think for sure that the interest rates are rising and that the whole game is over. So there's no way in the world the Federal Reserve could ever possibly, ever even remotely hint about raising rates. Because the moment they do, the system would crash. So the only way to do it is to do it with credible threats and to do it with deception. So you see how the yields are rising right now? You see how the Treasury has enough funding right now? You see how the capabilities of the Federal Reserve to mop up the liquidity could be? Now, a lot of people are going to argue with this a lot. I get it. I know why, because I have been following this for a long time, and there was a moment there in my life that I thought hyperinflation was right around the corner. But I'm starting to change my perception on a lot of things. One of them is the way Dr. Lacey Hunt talks about money velocity. And that's a whole other video, and we've talked about it before, but these are just some of the things that I've been thinking about lately. And, you guys know me, I got to talk about it. So, all right. Uneducated economist, you guys let me know.